Advanced semiconductor manufacturing requires extreme wafer surface cleanliness to prevent catastrophic gate oxide breakdown. As transistor dimensions shrink toward the single-digit nanometer scale, the number of wet cleaning steps scales nonlinearly. At 28 nanometers, a wafer undergoes 60 cleaning steps, consuming 4.2 liters of grade 5 ultrapure hydrogen peroxide. At the 2 nanometer node, this intensity escalates to 330 steps and 32.0 liters per wafer. This represents a 450% increase in cleaning steps. A standard gigafab processing 100,000 wafer starts per month at the 3 nanometer node requires approximately 2,450,000 liters of this specialized chemical monthly. The physical scaling of silicon is therefore directly tethered to bulk chemical logistics. The primary bottleneck in the ultrapure hydrogen peroxide supply chain is not synthesis capacity, but transport logistics. Grade 5 chemical purity requires specialized transport vessels lined with perfluoroalkoxyfluoropolymers, or Fa. Standard stainless steel containers are unusable because they leach metal ions at parts per billion levels. This leaching renders the chemical useless for advanced node fabrication. The global fleet of active PFA-lined containers is growing at an 8.2% compound annual rate. However, semiconductor-driven demand is expanding at 16.3% annually. By 2025, the structural deficit is projected to reach 570 units. This represents a 23.5% shortfall in global transport capacity. The physical chemistry of unstabilized hydrogen peroxide prevents long-term stockpiling. Without chemical stabilizers, which are themselves contaminants, the compound continuously decomposes into water and oxygen. This exothermic reaction is catalytically accelerated by trace metals. In standard stainless steel containers, metal leaching raises impurity levels from 5 parts per trillion to 2,200 parts per trillion within 30 days. This degradation violates the 10 parts per trillion limit for grade 5 applications within 24 hours. Simultaneously, the active chemical assay drops from 31.00% to 29.70%. PFA-lined containers mitigate this, maintaining impurities below 15 parts per trillion over 30 days. Consequently, manufacturers must build dedicated purification plants directly adjacent to semiconductor fabrication clusters to bypass global transit risks. The transition from silicon to silicon carbide is essential for high-voltage grid infrastructure. However, scaling production from 150mm to 200mm wafers has introduced severe crystallographic defects. In 2024, defect density on 200mm substrates averaged 3,700 defects per square centimeter. This is more than 4 times the density of mature 150mm lines. These defects, primarily threading screw dislocations, compromise the physical structure of the wafer. During high aspect ratio reactive ion etching, these dislocations concentrate electric fields. This causes localized gate oxide breakdown at voltages up to 30% below rated capacity. Consequently, manufacturing yields for 200mm trench devices remain suppressed at 58%. This is far below the 80% threshold required for stable, low-cost commercial volume production. The physical limitations of crystal growth are directly restricting the supply of advanced power electronics. Upstream semiconductor yield failures have triggered severe downstream macroeconomic delays. In 2024, the global supply deficit for grid-scale inverters widened to 33 gigawatts. Global demand reached 115 gigawatts, while actual shipments were capped at 82 gigawatts due to component shortages. This supply gap has caused procurement lead times to escalate dramatically. Average lead times for utility-scale inverters quadrupled from 16 weeks in 2020 to 60 weeks in 2024. This bottleneck has delayed over 30 gigawatts of planned solar and energy storage projects globally. The shortage is most acute in high-voltage classes, specifically 1,500-volt direct current and 3,300-volt alternating current systems. These systems rely exclusively on high-voltage trench silicon carbide devices to meet modern grid efficiency mandates. Without these components, utility-scale decarbonization projects cannot be commissioned. Transition to trench silicon carbide architectures represents a major electrical performance leap offset by manufacturing complexity. Trench devices achieve a specific on-resistance of 3.2 milliohms square centimeter. This is a 62% reduction compared to planar silicon carbide and a 97% reduction compared to legacy silicon. This architecture enables a highly compact die size of 25 square millimeters. This physical compaction theoretically increases the gross number of dies per wafer by 68% over planar designs. Furthermore, trench devices reduce switching losses by 92.8% compared to silicon-insulated gate bipolar transistors. However, these physical advantages are offset by a low 55% manufacturing yield at the 3,300 volt rating. This low yield inflates unit costs and limits widespread market adoption. Until crystallographic defect rates are resolved, legacy silicon and planar technologies will remain dominant in cost-sensitive grid applications. The global transition to electric vehicles is directly constraining the decarbonization of heavy metallurgy. Synthetic graphite anodes for lithium-ion batteries require the same highly crystalline needle coke used in electric arc furnace electrodes. In 2018, metallurgical electrodes dominated this market, consuming 850,000 metric tons, or over 77% of global supply. By 2023, this relationship inverted as battery anode demand reached 920,000 metric tons, surpassing steelmaking requirements for the first time. This structural reallocation is accelerating. By 2026, battery anodes are projected to claim nearly 64% of the market, systematically crowding out metallurgical applications. This supply-demand imbalance has pushed the global needle coke market into a persistent structural deficit. The market shifted from a 40,000 metric ton surplus in 2018 to a 95,000 metric ton deficit in 2023. This shortfall is projected to more than double by 2026. Consequently, spot prices for premium petroleum-derived needle coke escalated from $1,600 per ton in 2020 to $4,500 in 2024. This represents a price increase of over 181%. Even lower-grade coal tar alternatives have seen their historical discounts narrow to under 8%, due to systemic shortages of low-sulfur feedstocks. The rising cost of needle coke is directly inflating the capital requirements for green steel production. Manufacturing 1 metric ton of finished ultra-high power electrode requires approximately 1.2 tons of needle coke due to material loss during high-temperature baking. This high consumption ratio makes electrode pricing extremely sensitive to raw material volatility. Between 2018 and 2024, the total manufacturing cost of these electrodes rose 50%, reaching $9,000 per metric ton. Needle coke inputs alone now account for $5,400 of that total. Compounding this, energy and baking costs rose 54.2% over the same period, threatening the operating margins of electric arc furnaces. The physical scaling of wind energy infrastructure is structurally limited by specialty chemical synthesis. High-performance turbine blades require massive quantities of epoxy resins derived from epichlorohydrin, or etch. As shown in the stacked area chart, global production is undergoing a critical structural shift. Propylene-based ECH capacity contracted by 5.1% between 2021 and 2024 due to environmental regulations. Consequently, the market is increasingly dependent on bio-based glycerol pathways. At the same time, wind energy's share of global ECH consumption has more than doubled, rising to 22.5% in 2024. This creates a direct collision between decarbonization targets and chemical supply constraints. Dual pathway structure of ECH production exposes wind turbine manufacturers to complex feedstock volatility. As plotted on the dual-axis line chart, ECH spot prices peaked at $3,400 per metric ton in early 2022. This surge directly mirrored a 214.2% spike in crude glycerol, a byproduct of biodiesel refining. The bio-based ECH pathway is highly correlated with global biodiesel production swings, showing a correlation coefficient of 0.89. Meanwhile, the traditional propylene pathway remains highly sensitive to chlorine loop energy costs. A $100 increase in propylene feedstocks translates to a $165 increase in synthetic ECH production costs. This dual exposure leaves blade manufacturers highly vulnerable to external energy and agricultural shocks. The material bottleneck is compounded by the cubic scaling laws of structural wind engineering. As rotor diameters expand to maximize aerodynamic efficiency, blade mass increases nonlinearly. The horizontal bar chart illustrates this exponential physical progression. Scaling a rotor from 120 meters to 240 meters increases single-blade mass by over 400%. This physical scaling drives an exponential demand for structural epoxy. A single 240-meter rotor set requires 71.8 metric tons of epoxy resin, consuming nearly 24 metric tons of ECH precursor. Consequently, a 1 gigawatt offshore wind farm requires approximately 1,580 metric tons of pure ECH. This extreme material intensity makes global offshore wind deployment highly vulnerable to localized chemical supply shocks. The extraction of critical transition minerals is structurally bound to fossil fuel markets. Industrial blasting agents rely on low-density ammonium nitrate, which requires ammonia synthesized from natural gas. This thermodynamic link exposes the entire mining sector to severe energy market volatility. During the 2022 energy crisis, European natural gas prices peaked at an annual average of $40.30 per million British thermal units. This surge drove Baltic ammonium nitrate spot prices to a record high of $680 per metric ton. This represents a 223.8% increase relative to 2020 baselines. Although natural gas prices stabilized to an average of $11.50 in 2024, structural risk premiums remained. Ammonium nitrate prices settled at $340 per metric ton. This represents a permanent 61.9% elevation above pre-crisis levels, locking in higher baseline extraction costs. The global supply of mining-grade ammonium nitrate is highly concentrated in geopolitically sensitive regions. The Russian Federation maintains a structural hegemony over global exports, controlling 38.2% of the seaborne market as of 2023. This concentration exposes Western mining operations to severe geopolitical chokepoint risks. Simultaneously, China's export share collapsed from 9.5% in 2021 to 3.1% in 2023. This decline reflects strict state-mandated export quotas designed to prioritize domestic agricultural security. These quotas effectively restrict the global supply of energy-intensive chemical precursors, with Russia, China, and Egypt controlling over 51% of global exports. Supply chains are structurally fragile. Mining operators are forced to secure long-haul logistics, which increases transit times and heightens exposure to maritime shipping disruptions. This geographic rigidity prevents rapid supply diversification when regional production halts occur. Extreme chemical deficits translate directly into higher operational costs at the mine face. In Latin American copper mines, blasting costs per ton of run-of-mine ore surged by 117.7% between 2020 and 2022. This escalation was driven by a heavy reliance on imported ammonium nitrate and high-cost emulsion precursors. A similar trend occurred in North American nickel operations, where deep open-pit configurations require high stripping ratios. Blasting costs there escalated to $1.12 per ton in 2022 and remained elevated at $0.89 in 2024. These persistent costs directly threaten the economics of low-grade mineral extraction. This chemical bottleneck is compounded by declining ore grades worldwide. As near-surface deposits deplete, mining operations must move more waste rock per unit of refined metal. This rising stripping ratio increases the physical volume of blasting agents required, amplifying the impact of the chemical deficit on the global energy transition. The rapid expansion of low Earth orbit satellite megaconstellations has exposed a critical material bottleneck in the space-grade photovoltaic supply chain. Space-grade solar arrays utilize high-efficiency gallium arsenide cells that require shielding from ionizing radiation. This shielding is achieved using ultra-thin microsheet glass doped with cerium oxide to prevent radiation-induced browning. Global demand for this specialized glass has scaled from 1,400 square meters in 2018 to an estimated 15,300 square meters in 2024. This represents a 48.9% compound annual growth rate. Meanwhile, global production capacity expanded at only 18.5% annually, creating a structural deficit of 9,200 square meters in 2024. This supply gap is projected to widen to 14,000 square meters by 2026. The underlying cause is the extreme physical difficulty of drawing, borosilicate glass to sub-millimeter thicknesses without introducing microscopic defects. The physical scarcity of cerium-doped glass has translated directly into severe procurement friction for satellite manufacturers. Average lead times for 100-micron borosilicate glass rose from 12 weeks in 2018 to a peak of 52 weeks in 2023. This extended timeline disrupts high-rate industrial assembly lines, forcing manufacturers to hold larger buffer inventories. Simultaneously, unit costs for standard 100 square centimeter cover glass escalated by 255%, rising from $45 to $160. This price surge reflects both raw material costs and the high-yield manufacturing premiums charged by specialized producers. Despite these rising costs, substitution is not a viable engineering option. Non-doped alternatives suffer from rapid radiation browning, which degrades light transmission. Cerium-doped glass limits simulated 10-year transmission loss to under 1.5%, making it mathematically indispensable for orbital longevity. The production of this critical material is characterized by extreme geographic and corporate concentration. Over 80% of global space-grade cerium-doped glass is manufactured by just 2 European entities, Cheoptic in the United Kingdom and Scott in Germany. Cheoptic alone operates 4 of the world's 9 active vertical draw towers, maintaining a 52% market share. This concentration introduces severe single point of failure risks into the global space economy. Any localized industrial disruption at these European facilities would immediately halt satellite manufacturing pipelines worldwide. Meanwhile, Chinese state-backed entities have expanded their capacity share from 5% to 12% to support domestic megaconstellations. This state-directed expansion highlights the geopolitical dimension of the bottleneck. Western commercial operators remain entirely dependent on a highly fragile, highly specialized European supply chain. Geopolitical escalation in the Bab al-Mandeb Strait has forced a structural reallocation of global shipping lanes. Monthly transits through the Suez Canal collapsed by 64.6% between October 2023 and June 2024. This represents a drop from 1,910 to just 675 vessels. Simultaneously, traffic bypassing the canal via the Cape of Good Hope surged by 398.5%. This rerouting adds up to 14 days of transit time between Asia and Europe. The sudden diversion has transferred massive physical fuel demand to the African coastline. Marine fuel demand in the southern and West African port range expanded from 185,000 metric tons to 580,000 metric tons over the same period. This represents a 213.5% structural increase. The regional bunkering network is now under unprecedented operational stress. Sudden transfer of marine fuel demand has exposed severe capital underinvestment along the African coastline. The primary physical constraint is an acute shortage of double-hulled bunker barges. Cape Town operates with only 2 active units, causing average vessel wait times to escalate from 1.2 days to 6.2 days. At Durban, the largest port in the region, wait times increased by 587.5% to 5.5 days. This bottleneck is exacerbated by regulatory restrictions on offshore ship-to-ship transfer licenses. These policies prevent operators from utilizing floating storage to bypass berth congestion. Walvis Bay experienced an 8-fold increase in wait times, rising to 4.0 days. The port relies on a single active barge to service the diverted container fleet. Without rapid asset deployment, these localized infrastructure deficits will continue to compound global supply chain delays. The logistics bottleneck is compounded by a structural decline in regional refining capacity. Local refinery output of marine fuel oil fell by 53.5% between early 2023 and mid-2024. This decline was driven by the indefinite shutdown of major South African refining facilities. To compensate, regional import requirements for very low-sulfur fuel oil surged by 727.2%. Imports rose from 110,000 metric tons to 910,000 metric tons. This extreme reliance on long-haul product imports increases supply chain vulnerability and inflates regional price premiums. The resulting structural supply deficit reached 415,000 metric tons in the second quarter of 2024. This shortfall forces vessels to slow steam or ration fuel. Many operators are now forced to seek alternative bunkering stops as far north as the Canary Islands. Permanent magnets are critical to modern industrial and automotive manufacturing. While rare earth neodymium magnets dominate high-profile electric vehicle discussions, low-cost ceramic ferrite magnets represent the vast majority of global permanent magnet consumption by volume. These components rely on strontium carbonate as their primary chemical precursor. The global supply chain for this material is highly concentrated. China, Spain, and Mexico collectively control 89.5% of global refining capacity. Between 2019 and 2023, Chinese production capacity contracted by 36.9%, dropping from 65,000 metric tons to 41,000 metric tons. This contraction was driven by strict environmental enforcement, targeting toxic hydrogen sulfide emissions from the pyrometallurgical black ash process. Combined capacity expansions in Spain and Mexico offset less than 30% of this lost Chinese volume. This regulatory squeeze has triggered a severe structural supply shock. The contraction of Chinese refining capacity has pushed the global strontium carbonate market into a severe structural deficit. In 2019, the market maintained a 5,000 metric ton surplus. By 2024, this balance is projected to shift to a 28,000 metric ton deficit, representing a 20% supply shortfall. This supply-demand gap has driven an exponential price escalation. Average spot prices for technical-grade strontium carbonate rose from $1,450 per metric ton in 2019 to a projected $3,450 in 2024. This represents a cumulative increase of 137.9%. Historically low operating margins in celestite mining have discouraged greenfield capital investment. Consequently, alternative mining hubs cannot scale extraction quickly enough to exploit these high prices. The supply bottleneck is now locked in for the medium term. The upstream chemical deficit is propagating directly down the industrial supply chain. Strontium carbonate is synthesized with iron oxide to produce strontium hexaferrite ceramic magnets. The raw material cost contribution of strontium carbonate to these finished magnets has risen from 22.3% in 2019 to 33.7% in 2024. This has driven a 57.7% escalation in total magnet manufacturing costs. Total costs rose from $1,300 per metric ton to $2,050 per metric ton over the 5-year period. Energy and processing costs also rose by 57.8%, compounding the raw material shock. Downstream, Tier 1 automotive suppliers are facing severe margin compression. The low-margin nature of auxiliary electric motors, such as those for windshield wipers and power seats, limits their ability to pass these cost increases onto automotive manufacturers. This chemical bottleneck threatens the profitability of basic automotive and industrial automation components globally.